Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden agendas in corporate filings. Today we're diving into something that sounds a bit dry but has some juicy details about how this fund is structured and what is coming next. If you appreciate breaking down complex financial documents into plain English, don't forget to hit that subscribe button and join our growing community on Discord, linked in the description below. Alright, so what we have here is a Form 8K filing from FS Specialty Lending Fund. Think of an 8K as a company's announcement system for big news. It is like their way of telling the world about really important stuff that happened outside of their regular financial reports. Now, FS Specialty Lending Fund, or the fund as it likes to be called, has been going through some changes. They used to be a business development company, or BDC, and now they've officially converted into a closed-end fund. This basically means they've adjusted how they're legally set up and how they operate within the investment world's rules. It is a big structural shift. The main event here happened on the 28th of October 2025. This is when FS Specialty Lending Fund merged with and into another company, a Delaware statutory trust, which then became the new FS Specialty Lending Fund. It is a bit of a mouthful, but essentially the old fund became the new fund through a reorganization. The investment advisor also got a new name changing to FS Specialty Lending Advisor LLC. This all happened to pave the way for something else. And what is that something else, you ask? It is their upcoming listing on the New York Stock Exchange. They're aiming for the 13th of November 2025 with the ticker symbol FSSL. This is a significant move as it will make the fund's shares much more accessible to a wider range of investors. It's like going from a private club to a public spectacle. Now, they are saying there is no guarantee this listing will happen exactly as planned or at all, but the intention is clear. Along with this planned listing, there are a few other interesting points. Franklin Square Holdings, which is the parent company of the advisor, plans to invest up to $20 million into the fund. That is a substantial commitment from the parent company, signaling confidence. Interestingly, this investment from Franklin Square will be managed by an investment committee. This committee will consist of 3 or more people who are not officers or directors of the fund itself. This is designed to make sure the investment decisions are independent and not swayed by the fund's internal management. It is a way to separate the investment strategy from the fund's operational leadership. Also, some of the fund's own management and board members are interested in buying shares after the listing. This is often seen as a positive sign, showing that the people running the show believe in the company's future performance. However, like many things in finance, there is no guarantee that they actually will buy shares. Then we get to something a bit more complex called participating funds total return swaps. Now, this is a financial instrument where other funds sponsored by FS will essentially get the economic benefit of owning shares in FS Specialty Lending Fund without actually buying them directly. They'll enter into an agreement for something called an equity total return swap, or EQTRs. These swap agreements are expected to reference up to a total of $75 million worth of shares and could last for 3 years. This structure allows these other FS funds to get the upside from the fund's performance while managing their own capital differently. It is a way to amplify potential gains for these associated funds. Now, for a bit of a tricky situation, there is some past litigation involving certain investments where FS Specialty Lending Fund and others were investors. Affiliates of a former part owner of the advisor are being sued, and they are asking the fund and the advisor to contribute to their legal fees and any potential settlement or judgment. They're claiming this contribution is based on the fund's share of those troubled investments. The fund and the advisor are looking into this, basically deciding if they have to pay anything. They are hoping to use insurance to cover any costs, but there is no certainty on whether insurance will cover it all. If they do have to pay and insurance doesn't cover it, then it could be a big financial hit for the fund. This is definitely a risk factor to keep an eye on. Moving on to their performance, you can find a presentation that gives details about their financial and operating condition for the quarter ending the 30th of September 2025. It also gives an overview of their investment portfolio as of the 30th of September and more recently on the 4th of November. This presentation is on their website. They are cautioning that this presentation contains forward-looking statements. This means they are talking about what they expect to happen in the future, which can sometimes be different from reality. Regarding fees, the fund has an investment advisory agreement that outlines a base management fee and an incentive fee. There are different rates for periods before and after the listing date. The advisor has agreed to waive some fees if the pre-listing fees would be less than what they would be after the listing. This is to ensure the fund does not pay more in fees than it would under the post-listing structure during this transition period. It's a way to keep costs predictable during their change of status. The report includes a standard cautionary statement about forward-looking statements. They're basically saying that predictions about the future are uncertain and a lot of things can change that might make actual results different from what they're expecting. Things like economic changes, geopolitical risks, natural disasters, and even new laws can impact their performance. They are also stating that they don't have an obligation to update these forward-looking statements if things change. So what does all this mean? First, the fund is undergoing a significant transformation from a business development company to a closed-end fund with a planned listing on the NYSE. This move could bring more capital and visibility. The commitment from the parent company and potential interest from management are positive signs. However, there are risks. The previously mentioned litigation could lead to unexpected costs. The success of the NYSE listing is not guaranteed, and future performance will depend on many external factors as outlined in their cautionary statement. The fee structure also has some complexities during this transition period. The FS Specialty Lending Fund is clearly in a transition phase, aiming for greater public market access. The strategic shifts and planned listing are bold moves, but the company needs to navigate potential legal challenges and market uncertainties carefully. We'll be watching to see if this transformation leads to sustained growth and profitability for investors. Alright, that is our breakdown of this filing. What is your take on these changes and the potential risks and opportunities for FS Specialty Lending Fund? Let us know in the comments below. If you found this analysis helpful, please give it a thumbs up and subscribe for more in-depth corporate dives. And don't forget to check out our Discord community for more discussions about these filings. Thanks for watching and see you next time.